two, not two. You don't about to do what? In that dog.
You want to take over?
I'm gonna give you a little secret thing, man. It changed my life. I was 35 years old. You can't.
That's my bootleg music.
Give me a second. It's not pulling up for me.
You're fine. I'm going to go ahead and start. If I
Yeah.
can see your faces, that would be awesome. If you guys want to turn your cameras on. Your pictures look nice, but I'd rather see you in live. Hi, everyone. Welcome to our Wednesday night Multifamily Freedom Chasers Financing Zoom call. My name is Shelly Miles. I'm a commercial mortgage broker and a co-founder of our company, Adventure Commercial Capital. Together with Mr. Jerry Miles there, you'll hear from him in a moment. What our company does is connect real estate investors like yourself to lenders. With that, I'm going to give it to Jerry if he's ready.
I'm ready. Can you see my screen?
Yes.
Okay, great. All right. So I am Jerry Miles, the other half to Shelly. We are the co-founders of Adventure Commercial Capital. Go a little over the agenda today. I've got my cash flow hat on today, as you can see. We signed up for the third year of Grant Cardone's Real Estate Club, so we got some hats and some merchandise. So I figured I'll wear it tonight. So today's agenda, we'll be talking about the community ecosystem, and we'll do some introductions. We'll give you guys a chance to introduce yourselves if you'd like, and we will tell you a little bit more about ourselves. We'll go over the current debt market. We'll talk about rates and different things that we're seeing in the market. And then our main topic is hard money and bridge lending. And then at the end, we'll do some Q&A. And we usually do these calls in about an hour's time. Sometimes we'll be over 10 minutes, but usually right at an hour, we're just about done. So the MFC community, the Multifamily Freedom Chasers. I'm going to pull up the chat. If this is your first time on an MFC call, why don't you give us a 1 in the chat and let us know. But the Freedom Chasers community, we do, okay, I see Yvonne. It's first time.
Welcome.
Welcome, Yvonne. Okay, cool.
Thank you.
Yeah, for sure.
Glad to.
So Monday nights, we have alternating groups that host the call. And it is, sorry, I'm trying to let people in at the same time here.
Hey, I'm doing that. Don't worry about it.
Okay, cool. All right, so Mondays, we have alternating calls with Trevor Walker. Usually has a guest speaker or someone who has done a lot in the real estate arena. We'll be on with him. Off Mondays from him, we have Bibi and Iffy. And they have actually bought 2 deals here this year, 2 multifamily deals. And they talk about asset management, go deep diving into asset management and building teams. We, on every other Wednesday, talk about the debt market and educate you as best as we can on the debt market. And then the off days from us are Ed and Kevin, and they are both commercial brokers. So they sell deals and teach you how to communicate with brokers and source deals. So it's a really good lineup. And, all the calls are free. So I would, highly recommend joining any of the calls and being a part of as many of them as you can. So, all right. So different ways to plug in.
Sorry. I am going to, if this is your first time on the MFC call, or on this call, put a 1 in the chat. I know some of you just joined. I'm going to put a link so you can join the Facebook page that he just shared. Sorry, you can continue.
Okay, cool. So all these different places are places you can plug in with the Freedom Chasers: YouTube, Spotify, Facebook, WhatsApp, Instagram, and of course on these calls. And so who are the Miles? That is me and Shelly and two of our boys. JJ is on the call here. And I believe I made him a co-host so he can help us out. But he just graduated high school, was valedictorian of his class. We're super proud of him. And he is a YouTuber. He is just started getting paid for his YouTube content. So he's doing what he wants to do and starting to get paid for it now. So and then that's Jordan there with him, next to him. And he's going to be a freshman in high school next year. And already this year, he's I'm losing my page here. Give me just a second. But he, as an eighth grader last year, already got some varsity basketball time and got some first varsity points and all that here this past year playing varsity basketball. So we're super proud parents if you can't tell. So, but but yeah, my wife and I, we've run a commercial roofing business for the last 20 years. Started investing in real estate about 10 years ago. And 4 years ago, we started our lending company. And so we've been in this business here now through COVID. And now the second half of these 4 years, we've been, through the business here and, through these rate hikes and all that's going on. I will tell you, it's not an easy business to be in the current marketplace. They're projecting that this year, more than half of all commercial lenders and residential lenders or mortgage brokers will, fall out of the market and not work in those fields anymore. And the same with realtors is what I've heard. And actually, they're talking like more realtors will be out of the arena. So, but that's us. And I would like to open it up. Probably got time for 3 different people.
If you want to raise your digital hand, we can get you up here in an
Yeah,
order.
I see quite a few people I know already.
I know our friend Elise just joined. I don't know if she wants to jump on here and say a few things.
Yeah, I see Elise and I see Jason Nicholson.
She's got a podcast going.
Yeah, tell us about your podcast, Elise, if you'd like. Hey, Elise.
Hi, my name is Elise Lynn. Hi, Jerry. Hi, Shelly.
Hey,
And
good to see you.
I miss you guys. Yeah, my name is Elise Lynn, and I am a transformative coach, author, speaker, and also real estate investor. Yes, we do have a podcast. That's a EM Square Investor channel and webinar. Actually, tomorrow we will have a webinar. And our guest speaker is Madhavi Jain. She's a phenomenal. She has a she's a phenomenal investor as well, and she also has her own podcast as well. And she will be sharing with us about how to grow financial wealth, and also talk about some of the due diligence, that the pitfalls that we can avoid while investing, making decisions on our investments. So yeah, you guys are welcome to join. But I love Jerry and Shelly because they just always giving and giving and giving. You guys add so much value. So from time to time, I love to come and join you guys and check out what you guys have. Thank you
Awesome.
so much for having me.
We love when you come on here, Elise. Good to see you.
Yeah, I
Thank
suggest you jump on her webinar tomorrow. If you have a link, Elise, go ahead and drop it in the chat when you're ready.
Okay, I will. Thank you so much.
For sure.
Great
And,
seeing you guys.
yeah, good to see you. And Elise is an active investor. Her and her husband own multifamily and have owned multifamily for years. So a lot of experience and a lot of wisdom there. So definitely plug into her webinar things. So
Yes.
Thank you.
yeah. All right. And I see Henry on here as well. Henry, Henry is located up between Cleveland and Columbus. And yesterday he was wanting to meet with me, and I said, I don't think I can get up there today. I'm gonna, I was thinking we'd be driving and meeting each other like halfway. And he said, no, I'm gonna fly down. And then I go to pick him up at the airport, and I find out he's got his own plane and everything else, and flew down to meet me for the day. So it was good spending some time with you yesterday, Henry.
Oh, okay. Okay, nice to meet you, Henry.
Yeah, nice to meet you all. Yeah, I didn't know I could unmute myself. Yeah, good to meet you.
Yeah. And I sent you a quote over today, and it was a good one. It's about the best I've seen from a private lender in a long time. So
All right, all right. Good
yeah.
stuff.
I'm gonna share that with everybody here in the current debt market, because it was probably the most you know aggressive quote that I've received, that I've received from a private lender here in the last 2 years probably. So
Gotcha. Yeah, I got your letter last night, but I didn't see anything today, so I must have missed it. So I'll be looking for that.
for sure, man. It's good to see you. All right, so we'll go ahead and move on here to the current debt market. So where are the current rates? The Fed today had a meeting and came out, and they kept the rates where they were. No raising, no lowering. So we're still stuck at the 5.25 to 5.5, highest federal funds rate in 22 years. You know, our rates are not directly based on the federal funds rate, but they are indirectly based on the federal funds rate. A lot of our rates and things that you will get from us when it comes to long-term debt are going to be based on the treasuries, or the U.S. Treasury yield, or you'll hear it called a lot of different things. That you'll see a 10-year Treasury, 7-year, 5-year, 15-year, and that's what your rates are based on. So the Treasury rates determines what we pay. Today, the 10-year Treasury is 4.3, and then so from that 4.3, they'll put a spread on there, and that is what your final rate will be on whatever loan product it is that you're working with. So if you're looking at agency debt, and you're in a conventional with agency debt, you can figure, depending on the asset, anywhere from 1.4 to 1.8 above the 10-year Treasury if we're looking at a 10-year fixed rate. And same with the 5-year Treasury. If you're looking at 5-year debt, you're going to put 1.4 to 1.8. If you're looking at smaller loan amounts, those spreads will be higher. If you get below 6.5, 7 million, the spreads are going to be probably 2 to 2.5 over top of the Treasury. So the Treasuries have climbed. I've seen them almost get to 5 here this year, and they've been down almost to all the way down to 4. So they've been jumping around in the 4s. So if you want to know, if you're looking and just trying to quote a deal real quick, or wanting to look and see what's this deal going to look like, if it's a bigger deal, I would say you're safe to say 1.8, above the Treasury. If you're looking at smaller places, where your loan amount is going to be, below 7 million, I would say, add 2 to 2.5 to that Treasury yield, and you'll get what your final rate will be. So, and because the Treasuries have been jumping around so much, a lot of lenders are not locking in rates until the day of close. So that can jump back and forth. 2 weeks ago, I was just changing these numbers here today before the call, and I saw 2 weeks ago that the 10-year Treasury was 4.6, and today it's 4.3. So I mean that's 30 basis points, a little over 0.25% difference, in 2 weeks' time. So it could go up that much, could go down that much, it could be more, but just things to figure. And it's a negotiating tool too when you're purchasing. So. These are updated rate sheets from Freddie Mac small balance loans.
That's not updated.
Oh, that's not the updated one. Okay, this is May 28th. It's just a little lower today, I think, than it was this time. It's
It's a tad.
like 5 basis points or something like that, lower right now than what this is showing. So, you know, you can see the loan to value, the DSCR, and then what the rates would be on each of these. You know, there's always buy down options. These are the, you know, what we call the small balance Freddie and Fannie, or this would be the small balance Freddie Mac. And that is Freddie Mac is up to 7 million. So when you're looking at this, if your loan amount's going to be 7 million or less, this is what your rates will be in the range of. If it's over 7 million, you can probably take a half a point off of each one of these. Half a point to, you know, 60 basis points, something like that. And this one here is the Fannie Mae. And once again, these are like, I think this is like 10 to 15 basis points higher than what they actually are today. If you want to take a picture, that kind of thing, I'll leave it up here for just a minute. You know, we have been in a really stagnant market over the last 2 years. I'm starting right now to see it breaking free just a little bit as, you know, owners that have been holding on, you know, they've been holding on, waiting, thinking, oh, rates are going to go down. I'll be able to get what I want to out of my property, you know, this and that. And they're, you know, a lot of them are starting to throw in the towel and say, okay, I'm going to get what I can get out of it. There's some of that going on. And then there's also some of, you know, the lenders might not extend another time. You know, if they're in bridge debt or something like that, they've probably got it extended a year. Maybe now they're on their second year of getting the term extended. And at some point, you know, the lenders are going to say, hey, you know, we need to sell this thing. You know, we need to cut our losses. And a lot of these bridge lenders, we'll talk about bridge lending and things here in a little while. That's our topic today. But you know, a lot of them are really hurting and in a bad way because of the stagnant market. They get paid when deals close, when deals trade. And so when deals aren't trading, they're not getting paid, and they don't have money recycling. So if they have, you know, let's say $50 million in their fund that they lend, you know, and they get to trade that once a year, you know, they're making 2 or 3 points on that $50 million. So they're making $1.5 million. If that 50 million sits there and they maybe only get to recycle, you know, let's say 10 million of it because the market, you know, things aren't selling and people aren't buying, then, you know, their bottom line is really getting hurt. So, but there's going to be a lot more opportunity coming. And I think if you've been shopping for deals, you're going to see that there's opportunity coming, and you know, there is a major correction underway. You know, almost $3 trillion of debt maturing by 2027, half a trillion in 2024, half a trillion 2025. These numbers will actually be a lot higher than that, because I don't think that they're taking into account, or I know they're not taking into account, debt that matured in 2022 and in 2023 that have been put on extensions. So these things have been put, you know, they're kicking the can down, you know, down the line a little further so they can, you know, so they can have a chance to, you know, wait the market out. And the market is just taking longer than a lot of people are expecting. So, so I think that these numbers of, you know, a half a trillion mature in 2024, half a trillion mature in 2025, I think is going to be much higher because these bridge lenders are going to start pushing people out of their loans. And I'll tell you, like we get calls on a weekly basis of people that are in deals that they bought, you know, 2 years ago, 3 years ago, 4 years ago with, you know, maybe a bridge loan or a construction loan. And these loans have been you know, past their term. And, well, I'll just give you an example. There's a hotel out west, and it's a flagged hotel. It's got a big name on it. I don't want to give too much information on the deal, but they called me, and they've got a construction loan that they took out almost 2.5 years ago. The lender's getting antsy. It was a 2-year loan, and the lender's like, we really need to get you out of this loan. They were expecting, they bought the place for 12 million bucks, really nice hotel. Bought it for 12 million bucks, $8 million in debt on the place, so 4 million in equity. Well, they're needing to refinance, and with the new rates, being on hotels right now, we're 7.5 to 8.5% on a hotel. Their cash flow is not going to cover an $8 million loan. The most they're going to be able to refinance for is about 5 million. So if they want to be able to refinance this property, they're going to have to bring 3 million in cash to be able to refinance it. And then just to go beyond that, the lender, I think, is going to end up forcing a sale on the property, because there's really no way out for them. And when they force a sale and you can only get a loan for 5 million, what do you think that the sale price of this hotel is going to be? Yeah, I mean, it's going to be what, 8, 9, 10 million, maybe if they're lucky, 10 million, probably 8 million, 8.5 million. And so they've got $4 million in equity of their investors' money, probably, that's just vanished overnight, because of the rates raising. No fault of the guy running the deal. I mean, he was doing what everybody else in the world was doing at the time. Take out as much debt as you can. You're going to be able to refinance it in 2 years. You get your cash flow up. You make the place nicer. But that's just one deal out of thousands of these deals that are out there like that right now. And they're all hoping and praying that the rates come down. And they've been talking since this time last year that rates are coming down, and they haven't come down yet. So that's the current debt market. That's kind of where we're at with that. So our topic for tonight, we're talking hard money, bridge. A lot of people, different terms give people different feelings and different tastes in their mouths. If I say the word hard money to somebody, they might think of a loan shark, or something like that. Or if I say bridge, you got a different feeling about it. If I say private money, private money might make you think a different way about the funding or the money that's coming. So what's the difference in hard money, bridge, private money? We're going to talk about them and what they are. Hard money, kind of got that name back, 08, 09, when people couldn't get loans, and they were doing fix and flips on these houses and stuff like that. And you would get money from these, guys that would raise, a couple million bucks and start, funding fix and flip deals, or helping people buy the bank owned homes and all that kind of stuff during the mortgage crisis. Hard money is just another word for private money. And these things, private money, hard money, they fund a lot of bridge loans. So, these are all just different terms that, have a little bit of different meanings or different thoughts behind them. But, all in all, it's all kind of the same thing. You might use a bridge a little different than you would use, like, private money that you're borrowing for a construction loan or whatever, but it's still a bridge because you're working to get to either a sale or a refinance to get out of the deal. So, with all these products, there are no specific rules. Like when we look at home mortgages, you've got, thousands of pages of rules and things like that that the lenders have to follow and the banks have to follow and things. When you look at, one of the best ways to finance apartment buildings is through Fannie and Freddie. And they've got tens of thousands of pages of rules and guidance on how they have to lend the money and the right ways to do it. When we're looking at bridge financing, hard money, there is no specific rules, and it can be really flexible. It's lender to lender. What's this lender going to do, and how do they want to see it, and what are their investors' appetite? So, who gives these loans? Institutions. You'll find life insurance companies, banks, the big real estate trusts, hedge funds, family offices, private lenders, individuals. If you go to Uncle Bill and you're wanting to do a real estate deal, and Uncle Bill's got a couple $1,000,000 and he can fund it for you. I mean, that's a hard money loan or a private money loan right there. And it's, like I said, there's no set rules. If you guys agree and he's happy with you giving him 3%, more power to you. I hope it works out. If he wants 30% and you can make money on the deal with 30%, so be it. I mean, there's people doing it both ways. So, why would someone go to use hard money or bridge financing? I'll tell you, a lot of the people that have used bridge or hard money financing, before the rates kicked up, a lot of these people are in trouble. We have, through our organization, we're part of the National Association of Commercial Lending Brokers. Through our organization, we have probably 15 to 20 different bridge lenders, hard money lenders in that group. That was 2 years ago. About half of them right now are out of business. They've just closed their doors. They're not lending. And the other half that have not closed their doors and are still lending are very, very, very cautious on what they're lending on. I talked to one the other day. He manages just shy of $500 million, that he puts to work, in commercial real estate. And they do all different types. They did short-term, 1 to 2 year loans on, hotels to apartments to industrial, whatever it was that he thought was a good deal. He would put money into it. He shut his fund down. He said, we're still collecting money on deals that are out there. He said, but we're not forcing people out of the deals. He said, we don't want to force them to sell if they're not ready to sell. He said, but we're shutting down all lending and we're returning capital to our investors. And so I was asking him, so what's your plan? And he said, well, right now, he said, we're just shutting down. And he said, we probably will look at opening the fund back up in 2026. That's how long he's expecting, to see, for this cycle to last before he's ready to start putting his money to work again out in the market. So, and, you hear that number, $500 million, $500 million, in the commercial real estate space. I mean, he's one of the small players when we're looking at the lending guys and people that are doing those types of deals. So, but there's a lot of others just like him that are kind of taking that same approach. So why would someone use hard money or bridge? To bridge a gap. We turned in an LOI to a customer today. They've built a couple of duplexes. They had a buyer. The buyer backed out at the last second, and their construction loan is come due July 1st. And the lender that they have the construction loan with, it's not us, but they've said, we are not doing an extension. You have got to either sell or you've got to refinance this loan. And so we're working on a bridge loan for them right now on 2 new duplexes down in Florida that they built. So what they need the bridge loan for is they need it for 3 to 4 months to give them time to sell the property. The property's ready to sell. Buyer backed out. They were in good shape. The buyer was paying cash, and in the last minute, we're not doing it no more. And so now they're having to scramble, and we can close a bridge loan pretty quick. We're going to need to do this one in about 2 weeks, but we're paying off the construction loan and giving them that 3 to 4 months that they need to be able to get their property sold. So that's what a bridge loan is. I mean, sometimes you need it for a couple years. Sometimes you buy an apartment building or buy an asset and you just need time to raise rents, or you need time to do some CapEx or get some apartment turns, or or if you're buying a warehouse, maybe you're shopping it around for somebody to do a triple net lease, or all kinds of different things you could be doing. And you just need that time because you can't qualify for long-term funding, CMBS loan or something like that if the place is empty. And it might take some time to find somebody that is one of these companies to move in to do a triple net lease or something like that. And you just need that time. And a bridge loan is a good option in those ways. So a fix and flip loan, that's a bridge loan. To bring something to stabilization, all these things. So how do these lenders look at deals? So when we're looking at long-term multifamily financing or a hotel financing, or any of these other different products, those lenders are generally looking at the income. They're looking at expenses. They want to see a 1.2 over top, or a 1.4, or whatever it is over top of whatever the expenses are and the debt service, and they'll give you your loan if your cash flow is good. When we're looking at hard money or bridge loans, a lot of times, these properties don't have the finances to be able to fund, to get long-term funding, is why they're coming to us for the bridge loans. So what are these lenders looking at? Number one thing they're going to look at is the exit strategy. So if you're buying a property and you're doing it with a bridge loan, that lender wants to see how you plan to take them out of the deal. So the one we just got an LOI out on it today. Their exit strategy is a sale. The lender's comfortable that in Central Florida, they're going to be able to sell a brand new built duplex, brand new duplex, that brand new construction. They're going to be able to sell it in Central Florida, and so this lender's comfortable with that. If you're buying a multifamily, they're going to want to look at the property and say, hey, when this thing gets stabilized, is this property going to be able to refinance for enough money to pay us off? If it's a sale, they're going to look at it. Well, who is going to be the target audience to buy this property? Who's going to be, or whatever it is, they're going to look at how you're going to get the loan paid off, if it's going to be done in a good time frame. So they're going to look at that exit strategy and the business plan. They're going to look at the experience of the borrower. Not everybody can buy an apartment building and turn it around, or not everybody can buy a self-storage property or build a self-storage property, or whatever it is. They're going to look at the experience, and you're going to have to be able to show that you have done these things before. So if you can show you've done these things before, that cuts down on the risk that the lender has. So another thing with the risk, the lenders also, for the last, I guess, since 2012, since the mortgage crisis or whatever, back before 2008, if you guys remember, they were lending people money, and they were lending 100%, loan to cost, and sometimes giving even more money than what they would pay for, for repair money over top of the mortgage, because they thought, oh, well, these properties are just going up and they're going to keep going up, and people were able to borrow real easy and get a high loan to value and all this. Well, a lot of these mortgage companies got hurt because when the secondary, there's a lot to go into there, but when the mortgage crash happened, the, lenders would have, 80 or 90% of the property value in debt, sometimes more than that. And the properties drop 30%, 40%, 50%. And the lenders there, and they have more out on the deal than what the deal's worth now, and they're selling at a loss. So since then, I mean, lenders have been a little more stringent on their underwriting. Hey, we like to lend 70% loan to value, 65% loan to value. And just like that hotel I talked about, what is that? I think they were at 70% loan to value on that, 66% or whatever loan to value on that hotel in out west I was talking about. And, the lender's still going to get their money. I mean, that hotel, that can only be refinanced for 5.5 million. That lender, they hold $8 million on that note, and they're going to be able to get $8 million out of that property. So it's, lenders are going to look at the risk and are going to say, if this property drops in 50% value, are we going to be okay? Or if it drops 30%, are we going to be okay? So they're going to look at exit strategy, their risk, they're going to assess their risk, they're going to look at the experience of the borrower, and they're going to look at the strength of the borrower and the asset. They're going to look, at the strength of the borrower financially and his experience financially, his experience running deals, all those things. And they're also going to look at the asset. What kind of terms can you expect to get with hard money or bridge? This is a wide spread on these because there's so many different deal types. I will say right now, some of our most aggressive lenders are our fix and flip lenders. We have fix and flip lenders and new home construction, like single family new homes. We can lend 90% of the cost of the project. And when it comes to fix and flips, we can lend 92% of the purchase of the house, and we'll fund 100% of construction. So, I mean, that's as aggressive as you'll see any lending products right now. But, terms you can expect, hard money and bridge, anywhere from 6 months to 5 years. You'll end up paying 2 points to, I say 6 points, but, I've seen people charging more points than 6 points, 8 to 16%. The one that we have an LOI out on today, it's such a quick turnaround and all that. It's 12.5%, 4 points to close. Pretty straightforward deal. And those are kind of your average bridge terms when you're looking at bridge, just bridge loans. I'm also seeing bridge guys right now, private money guys that have stopped charging annual interest rates. And they're now, instead of charging an annual interest rate, they'll say, oh, well, we're going to go 12% every 6 months. So if you figure that, I mean, they're charging 24% per year on first position debt, and it's just the market we're in right now. It's a risky investment for the lenders because who knows where the debt market's going and if they're ever going to be able to get out of this loan. So they're covering their bases. So. But that's what's going on in the bridge and hard money world. I'm gonna go ahead and pull up a quote that I told you I was going to do that during the current debt market. But this is a quote that we got today on a 22 unit property, nice location, nice property. But this right here, this is a private lender giving out these terms. And you see on the 5-year term side, 910,000, their max loan is 65%. So they're assessing their risks. They're saying we're not going any more than 65% on any multifamily deals. It's a non-recourse loan. But I want to show you all something. I talked in the beginning, I talked about the treasuries and how they base the rates on the treasuries. If you look here on the 5-year term, 5.12%. The treasury plus 2.85% is what they're doing on the 5-year term. When you look at a 10-year term, they're adding 2.4%, as a spread for the lender. So 6.68, on your 10-year term. So that right there is I've seen better pricing on, Freddie and Fannie debt, on CMBS debt, but when we're looking at private lenders, this is the best that I've seen. So. All right, and the slides I got next here are the credit slides. Did you want to go through those at all?
You know what? No, I'm not gonna go through those tonight.
Okay.
We only have about 15 minutes left. If you guys want to raise your digital hand or put your questions in the chat, I can read them out if you don't want to speak, but if you want to speak, that's fine with us. If any of you want to hear about the credit score and how to raise your credit score, just let me know in the chat, and maybe in 2 weeks, our next Zoom call, which is in 2 weeks, I'll probably go over it a little bit. It'll take about 10 minutes to give you some insights on how to raise your credit score pretty quick.
And
Okay.
we've had good credit for the most part, me and Shelly have, but she's learned all these little tricks and tips and stuff, and now we're both over 800, like well over 800 now. And it's all because of these little tips and things that she's been doing. So you want to make sure you tune in for that. I see your hand, Henry.
Yes, sir. So if you bring that quote back up again.
Yeah.
Yeah, so I was just going to ask you questions. So I might as well do it on the group, so other people might have questions too.
Yeah, this is
so
a quote for Henry. This is a deal he's buying. So.
So if I do the 10-year, which the interest rate looks better and so on, what's the chances of doing a refi in 5 to 7 years? What are they going to hit me up with? I mean, can I do that, or what are they going to say about that?
So you see the yield maintenance there, 114 months of yield maintenance. So the 100 months yield maintenance is the lender's going to try to get their interest, because they take these loans, they package them together, and they sell them to these bigger fish, the pension funds of a state, and all these different ones are buying these loans, and they're expecting to get this this return on this money. So if somebody refinances out of one of these loans early, then they lose out on that interest. So the yield maintenance is just a way of them, protecting themselves on, saving their interest that, saving the interest they would have gained, or that they're losing out on because you refinanced. So let's say rates go up from here. You sign on this loan, the treasuries go up a point or two. You're probably not going to have any yield maintenance to pay, because they're going to turn around and they're going to be able to sell that money, and they're going to be able to get a higher return because the rates are higher. But let's say the interest rates over the next 5 years drop a couple points. Your yield maintenance, they're going to look, oh, well, we're planning to get 2% a year, for this big pension fund or whatever it is. They're going to say, you're getting out of the loan 4 years early. They're going to probably try to hit you with like 8% or 9%, when you go to close the loan out. So that's why it's important to make sure that your business plan is kind of, tied in with with the debt that you're getting. There is ways, with this yield maintenance, a lot of times we can go back to the lender and say, hey, we like all this stuff, but we're not liking the prepayment penalty. What can we do about that? And they might come back to you and say, hey, we're looking at a 10-year loan. Let's do it this way. Let's do a 5-5-4-4-3-3-2-2-1-1. And what that means is, they're gonna, and year 8, they're going to charge you 2 points to get out of the loan. In year 7, they're going to charge you 2. In year 6, they'll be at 3. 3 points to get out of the loan early. And and instead of that 6.68, you might end up paying 6.9. Just because they're taking a little bit of that money up front and getting rid of that, getting rid of some of the yield maintenance or whatever. So hope that helps. That makes sense to you?
Yeah, makes sense. Yeah,
Okay.
thanks.
Yeah, good. Good. So any other questions? Andrea, good to see you. It's been a while.
Missed you guys.
Yeah.
Hi,
And
Andrea.
hey, how's it going, Shelly? It's been rough, to get your offer accepted lately. It's just a lot of back and forth with the brokers, and then of course they want to keep you in their back pocket. I had a question tonight, mostly about underwriting. So, since you underwrite 4 lenders, Jerry, and well, your team does, what we've seen lately. So we're working with a lot of direct to seller marketing. And so these sellers are sending us financials that have a capital expenditure, like a CapEx item, like roofing above the line, above NOI.
Yeah.
So how would a lender, would they take into consideration that $143,000 CapEx expense above the line or below the line when they're underwriting it?
Oh, they'll take that out of the expenses altogether. Yeah.
Okay.
Yeah, I mean the lender's going to want to see a good T12 and things like that, but when you're looking at those, you look through and you see CapEx expenses, just get rid of it and take it out of your math.
I thought so. I appreciate that.
Yeah, for
Yeah, we
sure.
were coming up and we're like 143,000. That was a lot in repairs. And so we just found out that the seller split up the 2 roofing expenses between year 1 and year 2. So yeah, we were wondering how the lender would look at that.
Yeah. Yeah, just take it out of there. They'll see it, and maybe when you call lender or whoever you call about that, just let them know, hey, I caught this already, so they're looking out for it. So
Okay.
some people you'll send it to, they'll just do a quick like once over and send it, depending on how busy they are, and they might not catch it right away.
Yeah, as we're finishing up the underwriting on this for pro forma because the call for offers is in 2 weeks. So I'll shoot you this deal so you can see if I can get a quote. It's in Cincinnati, of all places.
Oh, nice.
Yeah.
Very nice.
Cool. Well, love working with you guys.
Yeah,
Thank
for
you.
sure. Yeah, if you need us to do anything here on a deal in Cincinnati, just let us know. We'd be happy to help out
Sounds good. Thank you.
for sure. All right. So you guys can still ask questions. Raise your hand if you have questions, but I'll go ahead and finish up through the slides while we're doing that. Things that we need for a quote. T12s, which is your trailing 12. If you don't have 12, T9, T6, it's just your profit and expense report or your income and expense report. We'll need a rent roll as updated as we can get it. And OM is helpful. We don't really believe all the things that are written on the OM, but it is helpful to have an OM, just so, I mean, if nothing else, so we have the address of the property. A lot of times I'll have people send me a T12 and rent roll and there's no address, there's not a name of the property or nothing. And I'm like, what am I looking at? Is this in Nowheresville, Kansas, or is this in, Miami? You don't even know unless you have an address,
It
Uh,
looks pretty.
what?
OMs look pretty.
Yeah, they do. A summary of what you plan to do. I mean, are you making an offer on it? Are you under contract? What situation you got with it? Before we move, I know a lot of people, have KPs or, a key principal that would be signing on debt and stuff. So as we come into the time to sign contract and pay, due diligence fees and all that kind of stuff, we'll need to be having an SREO and a PFS to be able to have someone that qualifies to sign on the debt. What we need, for a DSCR loan, we've been looking at a lot of these here lately just because that seems to be what's selling for people. And there's a lot more of that business going on right now. Address, if it's a purchase, we need purchase price, refi purchase price, date when purchased, current value, monthly rent, taxes and insurance cost, and the borrower's credit score. Take a screenshot of that or whatever you want to do, but that is the basics of what we would need to be able to get a quote to you for a DSCR loan. What can you do today to, I just mentioned a KP. Most people on here, don't want to just be an LP. They don't want to be just another GP or someone raising capital or finding deals. They want to be the guy that can come or the girl that can come and sign on debt. That puts you in the driver's seat of the deal. But what can you do today to start working towards that? Make sure your credit is in order. Work on your PFS, SREO. And I think I said it before, that's personal financial statement and your schedule of real estate owned. Start working on your bio. If this is real estate education you're doing tonight, if that's all that you've done, put this on here. I had somebody, last year I was talking with them, and I'm he's telling me that he's new, he's never bought a multifamily, and he's new to this kind of thing, and it was a 10-unit property or 12-unit property or something he's buying in Las Vegas, and as I'm talking with him, he keeps telling me he's new and he doesn't know what he's doing, and I find out the guy had done like it was almost 50 wholesale deals last year, the year before. They're like, man, you're not new. I said, you've got a lot of experience buying and selling real estate. I mean, the wholesale 50 plus houses or almost 50 houses, that's some work, man. And you've done a lot of real estate deals. Let's talk about that, and let's tell the lender about that. Don't hold that back. So anything you've done real estate wise is experience that you need to be putting on your bio. You got to start working on raising capital. And if you don't want to raise capital, then you need to figure a way out to make more money. And a way to make more money, we've got, you got your business. You could do a business. You could, do all kinds of things. Wholesale houses, flip houses. Another way is our referral program. We pay people for referral fees. We've got a few deals out in the works right now where people are going to get 5-figure checks if we get deals closed with referrals that they've sent us. So, send them our way. All you have to do is make an introduction and we'll take it from there. So we'll be doing a call on our referral program here at some point in the near future. But, if you're looking to make more money, that's a good way to do it. Our verse for the week, it's Matthew 25:20 from, the story of the talents. If you've never read this story, go to Matthew 25 and read the story of the talents. It's a pretty good story. He's talking about business. So he who had received 5 talents came and brought 5 other talents, saying, Lord, you delivered to me 5 talents. Look, I've gained 5 more talents besides them. And after that, he said, well done. You've been faithful in the small things. Now I'm going to bless you with bigger things. And so that's how that story goes. It's a good one. Even if you're not a Bible reader, I encourage you to read that one. It's got business. Everybody on here is into business, so get on and read that story. Our next topic that we're going to talk about, it's the news story of the day, really, because that's all you hear about if you turn financial news on, is what is the Fed waiting for? We're going to talk about that not next Wednesday, the Wednesday after. So what is the Fed waiting for? Right here, I want to invite you to join the Freedom Chasers WhatsApp group. You scan that QR code and you can be in the group, post on there, gain contacts on there, whatever you want to do. If you have deals you're looking at, talk to people on there about it. there's some big guys in the chat, in that chat. I mean, if you have deals you're working on and looking at, there's people in that chat that I know personally that can sign on 30, 40, $50 million worth of debt if you need a KP on a deal. So it's a good place to be. Your network is your net worth is a true statement. And here is our contact info.
And I just dropped Jerry's information in the chat. If you're on a cell phone, you can just grab it there. And I did something last week that I didn't mean to do, and I'm doing it again one more time this week. I dropped his Calendly in there. You can jump on a 15 to 30-minute Zoom call with him. Go ahead and grab that and schedule it. I don't do it often. Those of you who are viewing the recording, the playback, you won't be able to get it. I'm sorry. You have to be on the calls to get it. So there you go.
Awesome. So that is my cell phone number. Feel free to call. That's my hi hello card that has all my contact info. And thanks for being on here, Elise. Good to see you. Just saw her in the chat. I think,
Yeah.
and join the calls. We got some good calls, guys, through the weeks. Every Monday and every Wednesday.
I'm dropping the Freedom Chasers Facebook link in the chat again. Go ahead and grab that if you're not a part of it already. And we will see you soon.
I will go ahead and add. I was at the last week on Thursday and Friday. I was at the Bring Your Deal workshop. We're in Grant Cardone's Real Estate Club, and they have, if you're not familiar with that, we have twice a year where everybody goes to Miami, and we have what's called the Bring Your Deal workshop. And there'll be 10 people a day hop up on stage in front of the whole crowd, and they'll present a deal to the crowd. And they'll present the deal. They'll go through everything, looking for investors, looking for KPs, or help people to help them bring the deal through. And there was a few good deals in the mix, but overall, it shows how hard it is to find a deal right now with the deals that were being shown. It's just, deals are getting harder and harder to come by, and harder to find. And it showed with the deals and things that were there in our Bring Your Deal workshop. So if you're looking for deals, continue looking and looking and looking and looking. When everybody else is giving up looking, you keep looking and you'll find them. That's what Andrea's been doing, I know.
Absolutely.
So all right.
Thank you all for being here, and don't forget to jump on our Zoom call in 2 weeks. Our topic is going to be, I forgot.
It's going to be what?
What's the Fed waiting for? Plus, I'm going to be doing a 10 to 15-minute education on how to boost your credit score pretty quick. So, all right, I'm going to leave you guys with some music, and have a good rest of the week. Bye.
Appreciate you guys. Thank you.
Thanks, y'all. Thanks for being here.
Thank you.
When I walk through the door, I'm talking cash flow. And if you know like I know, you're getting cash flow. Prove what? Getting money, never losing hope. But I'm broke, but now I'm living adding digits, counting zeros and some decimals. And I wish you would try to test me, yo. You should listen to the lesson, no. Masterminds out of Mexico, I invested though when I let it grow. Benjamins I got a pocket full. Rich income and your taxes low. Spend it right and then invest some more. And if you don't believe me, ask my doctor though. What you mean? You mean Uncle G? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be like Visa, MasterCard, American Express. I bought the bank and I bought the jet. I buy apartments, I send checks. Yo, billionaire went undercover, help y'all discover who did it.